Hi everybody, Thomas here. If you spend any time trying to invest in the stock market on your own, it's likely that more than once you found yourself wondering why it's so hard. The irony is that success in the market is often less about what the wealthiest 1% of investors are doing than it is about what they aren't doing. Even the most successful investors in the world have had to learn, usually through hard-earned and costly experience, how to eliminate habits and tendencies that come naturally to all of us. These bad habits come at least in part from a lack of experience and knowledge, but in most cases they really boil down to limitations of human nature. In this video, I'm going to talk about two of the biggest mistakes the average investor makes over and over again, usually without even knowing it. I'm also going to show how to replace those mistakes with powerful, proven methods of success. One of the biggest questions any of us have to deal with as investors is what stock to work with at any given point in time. After all, there are more than 15,000 stocks available on stock exchanges or over the counter in the United States, and most of us don't have access to the sophisticated screening tools and systems used by institutional investors and mutual funds. That usually means that we rely on simpler resources like Bloomberg, Yahoo Finance, or CNBC, who use popular experts to talk about the stock market. How about the opinions of friends, colleagues, and other people that you know who invest in the market? The problem is that with the stocks that both of these groups talk about, the best opportunity will have already occurred. Everybody else is already late to the party, and the best opportunities are in the past. The irony is that the vast majority of investors rely on nothing more reliable than these two sources to make their investing decisions. That's why I call this mistake following the herd. You buy a stock because everybody else seems to be doing the same thing. The real truth, however, is that history has proven that when everybody else begins buying a stock, that's usually where the latest upward surge ends. Everyday investors are always the ones that end up losing the most when the inevitable downward reversal comes. If you want to stop following the herd, you need to develop a method to find stocks on your own that will provide you with reasonable investing opportunities. A simple approach to doing this is to create a list of stocks that you can check on a daily basis. It doesn't necessarily have to be a long list or even be broad enough to cover every segment of the market. It just needs to have enough stocks in it to give you a basis to work from. You can use your list to check for news stories and information that could force the stock to reverse and start moving in a new direction, or that could give investors a new reason to keep pushing the stock in the general direction it's already been following. As long as you're diligent in checking your watch list every day, you can be assured of finding opportunities to make trades on a reasonably consistent basis. Another approach is to subscribe to Rebel Income. I've built my service to deliver timely investing opportunities at least once a week. That means I'm going to show you 4 setups each month on high-quality dividend-paying stocks trading at discounted prices. The advantage I want to give to you is that I'm doing all of the hard work of evaluating a stock's financial data and price activity for you. You save time since you don't have to worry about sifting through potentially dozens of stocks or more to find just a few to pay attention to. You have a direct line to timely information about stocks that are primed for good trading opportunities every week that you'd probably miss out on otherwise. Do you consider yourself a bargain shopper? Do you clip coupons before you buy groceries? When you shop for clothes, do you head straight for the clearance rack before anything else? Are you the type of person who always tries to talk salespeople into a lower price than what is listed before you make a major purchase? For a lot of people, the automatic answer to this question is yes, because doing anything else just doesn't make sense. Why pay full price for something when you can get the same thing or very nearly the same thing for a lot less? The ironic thing is that while few of us would argue with the logic of bargain hunting when it comes to retail goods, the average investor fails to apply the same mindset to the stock market. Even more experienced investors often don't factor whether a stock's price provides a bargain proposition into their analysis and decision making. It's like walking into a department store and just going straight to the latest stock clothing without even glancing at the clearance rack. It just doesn't make sense. The truth is that you can increase or decrease your individual chances of seeing the market's inevitable swings from high to low and back again work in your favor if you're willing to consider where a stock's price is compared to where it's been. It's a proven fact that all trends come to an end and reverse in the opposite direction, and that means that recognizing stocks at or near extreme lows is a good place to start putting the odds in your favor. Most investors tend to ignore stocks that have been beaten down in price. It's much easier to believe a stock is going to go up when you can see the stock has already been going up in the recent past, and so it's not surprising that not many investors spend time dealing with stocks at historically low levels. The truth, however, is that ignoring a stock just because it's been dropping is one of the easiest ways to miss out on big profit opportunities. Just like passing the clearance rack at the department store means you can miss finding great additions to your wardrobe at fantastic prices. Of course, the simple fact that a stock is trading at historical lows alone provides no guarantee that the stock will increase in price at any point in the future. That's why some of the most famous value-oriented investors in the market, like Benjamin Graham, Warren Buffett, and Charlie Munger, pioneered methods for identifying stocks trading at bargain rate levels compared to the value of their business. Some of the data points that I like to focus on and that reflect the spirit of value-focused investing include: dividends are arguably the most effective method for a company to pass value back to its shareholders. They're a great way for investors to generate useful passive income. Many fundamentally solid dividend-paying stocks currently offer yields that compete very favorably with what you'll be able to find even from long-term interest-bearing bond offerings. You can think of a stock's book value as the share price a shareholder would receive today if a publicly traded company closed its doors right now. It's what is left after a company liquidates all of its debts and pays all other outstanding capital expenditures. I like to think of book value as an indication of a stock's intrinsic value, which for my purposes is what I believe is the minimum price a stock should be under normal conditions. Free cash flow is a reflection of a company's ongoing access to cash. It describes the cash a company is able to generate after its capital expenditures. High cash flow means a company can accelerate debt payments, increase dividends, and expand its business operations through acquisitions or research and development. It's also a strong indication of a company's ability to weather the inevitable storms of economic or industry downturns. This is all about a company's financial flexibility. Does the company have the resources not only to pay their debts, but also to reinvest in their business? Under ideal circumstances, cash is as high as possible, with debt as proportionate to cash as possible as well. That isn't always possible, of course, but considering the two together gives me a way to think about what kind of financial foundation a company is built on. If you like this video, go ahead and give it a like. Help me grow my channel by hitting the subscribe button along with the bell so you'll get notified every time I upload new content. If you really want to leverage the power of my Rebel income system with information you can use every day, sign up for a free 7-day trial on my Patreon page. That link is in the description area of this video. Thanks for your time. I'm Thomas. Talk to you again soon. Happy investing, everybody.